Maverick Traders. Welcome out to your trading room for the week ahead as we prepare for February 12th through 16th. Let's go through some things. We're going to take a look at the markets. We're going to take a look at broad market analysis, the Dow, the S&P, the NASDAQ. We're going to take a look at sectors, what's moving, where we're grading them. Some plus threes, some plus twos. There's a lot of bullishness out there, but interestingly enough, there's also some bearish sectors. We'll review last week's trades and then we'll highlight some new trade ideas for the week ahead.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
So before we jump into it, we've got some fantasy football news. We are on Super Bowl Sunday. We've got fantasy football has wrapped up, and as always, we had a friendly competition with some prizes. So the grand champion this year was Justin. We cannot find Justin's last name, and we've got quite a few Justins as traders, so reach out to us. He was labeled as Michigan fan, so a great year for Justin. Not only did Michigan win the national title, but he wins the Grand Championship Maverick Football League. We also had league winners Brian J., Mark M., Vincent T., and Kenny B. Reach out to us. We've got $50 Amazon gift cards for you, but the grand champion, the $300 Amazon gift card. Let's jump into it. So last week, the index was able to push through this 5,000 point barrier, and that's a big whole round psychological number. So everyone was gearing up for S&P 5,000, and we broke through. We'll talk more about what we think that means. There were Fed speakers all week long. We had that kicked off with Powell on 60 Minutes on Sunday, and he struck a hawkish tone, basically said the same messaging, which is don't expect rate cuts in March. It's just not going to happen. ISM services at 53.4 versus 52, so a beat there. Initial jobless claims came in lower than expected, which is good. We want jobless claims low. We want people to be employed and not seeking jobless unemployment benefits and that sort of thing. So as we look at it, again, ISM's beat. There just was a light week as far as economics are concerned. Now, as we jump into the markets, you'll see that for the week, the Dow was flat on the week. And this speaks to it's not spread out. It's not like widely spread in terms of market breadth. It's led by the big tech names primarily. It's about 50-50. Half the sectors are really pulling the weight. The other half, some of them are in downtrends. S&P, NASDAQ, the Russell had a good week at 2.5% up. Oil was up 6% on the week, so a nice bounce back there. As we take a closer look, you can see that $5,000 or that 5,000 point mark on the S&P. Now we have punctured through that. Here's my thesis on this, and we've talked about this. I did the trading room last week, and I talked about this blow away rally, right? What they call the blow off top, where you're just accelerating to the upside. And as you accelerate, there's likely to be a big punctuation mark. Now, when you go to a big hurdle like this 5,000 points, usually you're going to puncture through it initially. And I talked about this week in the market roundup, where I think you surge through, and the reason it'll do that, it triggers a lot of stop losses, people saying, well, I can't stay short the market, I give up, I throw in the towel. And that's how trends come to die, is you have to push those final buyers over the edge. Now, those buyers are short coverers. That's buying pressure. They're also new buyers that are chasing momentum, all of that sort of thing. So if you get a big bullish candle up here, it is probably an exclamation point at the end of this sentence. And from there, you consolidate or correct back in price. But until then, we continue to see this big surge. It's playing out just as one would expect. Now, as we look at the NASDAQ, really nice bounce back here as we think about the NASDAQ components. most of tech is large cap tech is doing some heavy lifting here from a broad market perspective. Things like Amazon, Meta, all these different names are really have done well. When you dig below the surface, you also see the semiconductor sector has just been on fire. Absolute fire. Nvidia, Broadcom, all of these names have just been going up now for weeks. Now, as we look at this week's results, you can see over here in the green, the semiconductor sector, bright green. Right down here is another little semiconductor group, bright green. That was the sector of all sectors this week that were on fire. If you look for red right here in telecom services, and specifically, there was some news out that really hurt the Verizon, AT&T, Comcast group, and that is a partnership between Disney and some, Warner Brothers, some other entities where they're going to do a sports division and bundle those and have, a TV offering and so forth. And the thought there is, well, Comcast and these others that try to sell their services, well, this bundle is more competition. It may take customers away. For at least this past week, there was definitely some selling in that group. Now, we've entered into that blow off top phase. That means that things can speed up, not slow down, speed up as you're going into that blow off top. It's like a steady as she goes trend, and then in the late stages, you just go vertical. Look at what happened this week. ARM Holdings, which is a multi-billion-dollar corporation, one of the bigger semiconductor companies out there, was up 60% on the week. I mean, the entire stock value dang near doubled. Well, not quite double, but you get the point. Up 60% on the week is just gigantic. And that's what we mean by speeding up to the upside. You will see some really wild moves that you think about this corporation and you say, is it really worth 60% more than what it was before? Well, the market takes no prisoners, and those that were short just got blown to pieces, and they had to come in and cover their shorts aggressively and so on, and it was a big problem. We've got Waste Management reporting earnings on Monday. Coke, Marriott, Shopify, Cisco, KHC, which is Kraft Heinz, Occidental Petroleum on Wednesday, Applied Materials, Coinbase, Deere, DraftKings, Trade Desk, PPL on Friday. Earnings season is winding down, but some things to pay attention to there. We know we're paying attention to CPI data. The Fed wants to continue to see CPI drifting lower. Now, year over year, CPI is at 3.4. The Fed wants it at 2. Their mandate is 2%. So this is part of why at Maverick we haven't been calling for a March rate cut. That never made sense to us. They're still way above their target. So the economy's chugging along. Why would they come in and aggressively cut rates and risk inflation having a bounce back? So we think a little higher for longer on the rate side. We've got retail sales, Empire Manufacturing, retail sales, and then PPIs out on Friday. So certainly a much bigger week in terms of some economic events versus last week, which was purely technical. I should also note that next Friday is monthly options expiration. So at Maverick, we close our books on the third Friday. Our traders know that that's the end of the cycle. If you have a profit through this weekend, we send you out a profit statement and those sorts of things. So this week is the finish line for that. Our outlook remain bullish. Look, it gets to be, old saying it, but you're above the 20, you're above the 50, they're upward sloping. This is a bullish market. Dare I say it's kind of a runaway bull market right now, and you just stay to the upside. Now, if we break it down by sector, here's the way that the week shook out. Technology, again, a few names just really pumped up that sector. Consumer was strong, industrials, healthcare, those four sectors were all up 1%. Most of the others were around flat. You had comm services down 0.5%. You had utilities with the big underperformance. And interesting to note, we were most bearish on utilities. Last week, we highlighted a trade in the utility sector on the bearish side. So, certainly nice to see the worst performing sectors underperforming still. Now, if we look at their charts, XLU, the utility sector, we talked about this bear rally short setup, and it's playing out as one would anticipate with a push to new lows. It remains bearish. -2, getting towards a -3 type of category. XLC, the communication services sector, still strong, kind of a consolidating week, but still strong, still healthy. We're going to give this a +2. Certainly still above the moving averages and just sort of high basing up here. So still a healthy looking sector. The real estate sector has been really downward trending for the past month plus. Notice it peaked at the start of the year, well, you could even say back in December, and has been gradually moving lower since. Notice the crossover, the bearish crossover in the moving averages. So this looks like a bear rally short, sort of like what utilities looked like last week. We would think that real estate continues to lag. We're going to give that now moved into the -2 category as well. Healthcare, still strong. When you've been this strong and all they can do is push you sideways a little bit for a couple of days, you're still strong, you're still healthy, you are still continuing to push to the upside. This is a sector that I should note broke out before other sectors. Notice that it broke out a couple of weeks ago. Industrials is very similar. This broke out a few weeks ago, a couple of weeks ago, still strong. Yeah, slight consolidation for 2 days, but this is really just a minor high base and should continue to the upside. So those were a couple of the leading sectors. They broke out earlier than most. Financials, same type of dynamic. Now, this one's been in a consolidation for a while, so you could say, well, maybe it's well rested. Maybe it's poised to make the next run. I would still anticipate to the upside. Financials look strong. And if we look at consumer, now consumer is interesting because this is more of a trend reversal. This one had topped out back in December and been in a downtrend. And this week really changes that, right? It got it outside of its consolidation. So I would call this the early stages of a breakout. This is the first initial breakout phase. Now we're just in that continuation of trend. So still bullish. Look for pullbacks. Look for buying opportunities in consumer discretionary. Health, or pardon me, technology. This one has consolidated for a few weeks, but has re-established the uptrend as of Friday's price action. We have now pushed to a new high, so technology remains strong, still bullish. It's been the case, but it had been consolidating for a few weeks. Now we've officially broken out. Materials, underperforming, lagging, downward sloping moving averages, still more bearish than bullish. You could argue it could go either way on this. My guess is more likely down than up. We've got bearish crossovers in the moving averages. Just something doesn't act quite right. If you look at things within this sector like gold mining companies, they're just getting hammered, getting trashed to the downside. So continue to look for them lower. And then if you want a true zero, energy looks like a true zero. What do you make of this? Moving averages crisscrossing back and forth. Notice the cross above, the cross below, the sideways slope, the push above the moving averages, then back below, then above, then back below, then above, then back below. This is a zero in the purest sense. Energy just does not know which way it wants to go right now. So as we look at the group, still more bullish than bearish, right? We've got the 5 outperformers, consumer just starting to emerge in the upward phase, energy absolutely sideways, materials, real estate, and utilities on the bear side. So we're going to look at these sectors, and what we typically do is kind of say, okay, well, what looks really bad? What looks really good? and we'll kind of highlight different things within those groups as far as trading ideas, right? So let's take a look at these individual sectors and then dig down at some possible trades. Now, if you want to trade real estate, you could look at the individual components. This is not a super liquid sector, meaning most of the companies, if you go through the top 10 list of XLRE, if you say what's its top 10 companies, most of them do not have weekly options, as an example. So sometimes in that situation, you can just trade the ETF. Now, IYR is the exact same as XLRE. It's just a different company that does one versus the other. iShares does this, State Street does that ETF. But the underlying stocks are pretty much identical. Same companies in this ETF as are in this one. The charts pretty much look the same. The reason I'm going to trade IYR is because it has the weekly options, and I was looking for a February 23rd expiration. So the Feb 23rd expiration allows me to trade this bear rally short setup as an 89.86 bear put spread. Now what you'll notice about that is that it's actually a little bit higher risk and lower reward, but all we need is for it to finish below 86. If it gets back above 89, we've got a max loss, so it's much closer to our profit than to our loss zone. We have probability on our side, in other words. The trade would essentially look like this on the risk graph. So you have your profit, your loss, your break even coming in here, and then you'd have your share prices down here: 85, 86, 87, 88, 89, and so on. And the way that this particular trade would look on a risk graph is our max loss would be above 89, and so our loss would go that way. Our max reward would be if it was above 86, and so our reward would go that way. And then this would come through here as follows. And what you'd notice about this bear put spread risk graph is that our reward potential here would be a little less than our risk potential. So it might be a case where you're trying to make, let's say, 120 bucks to risk 180 or something along those lines. But that would be basically the risk graph. I've done these for so long. We used to draw these by hand a couple of decades ago. So I've drawn risk graphs for years and years and years. And now they actually pop into my head. Like I can just visualize a bear put spread, a bull put spread, a bull call, a butterfly, a condor. I mean, I can visualize all of these different trading setups where if you are looking at them and you just see a risk graph and it just, here's one that just goes that way, and then it has limited losses this way, and I would know, okay, well, we're making money as the stock price goes down in unlimited fashion. That's a long put, and you just get used to seeing these over and over again. So Thinkorswim is a great resource for learning risk graphs and utilizing those. Next trade idea: healthcare. Here I'm looking at Novo Nordisk. This one, March 1st, again using the weeklies, the 121, 125, which is just up off the chart, bull call spread. This one's more bullish in that your risk graph here would obviously go the other way, which is to say that higher prices would create the profitability, right? So you would have a risk graph that would look like that: more reward, less risk. And it might be a situation where you're risking 150 bucks to make 250 bucks. Something like that is more how that one would kind of be assessed. I don't remember the exact numbers on it, but it would be more in that type of category. Novo Nordisk, breakaway gap here after a high base pattern. We suspect a few more buying days coming up, buying weeks coming up. That is in a breakaway pattern. Last but not least, the energy sector we said was a zero. And when something's spot on zero, it's kind of interesting for a possible trade. Here's ConocoPhillips. COP is the stock symbol, and we were looking at a Feb 115, 110, 105 put butterfly. So let's break down that idea. Here's 115, here's 110, here's 105. Sometimes you can even look at these risk graphs in this fashion, but basically this particular risk graph would be as follows. Again, you always have your, whoops, this needs to be a minus sign. You have your profit above, your minus sign, and then you've got your break-even level. Now in this particular trade, we need to go below 105. Let's just put it, let's call it 103. How will this make the most sense? In fact, let's just go 100. 100 per share, 105, 110, 115, 120. Now, if you look at that particular trade, below 105 and above 115 is your max loss zone. So those lines will flatten out because there's a limited amount of risk, but it's if the stock's below 105 or above 115 per share. So if it's either it finishes above that or below that, you're at max loss. But if it's in this middle area, see between 115 and 105 is where it can get really exciting. Specifically if it lands at 110, and at 110 is your max profit peak. So your max profitability is the closer it gets to 110, and these lines would come up and connect with that area to show your profit zone, right? And there's a peak up here at 110 per share. Your reward potential would be greater than your risk, and you'd have yourself a nice little risk graph. Now, this trade, due to the fact that options are, whether you use the call butterfly or the put butterfly, there's what they call parity in the options, meaning that whether you trade the 115, 110, 105 call or put butterfly really doesn't matter because they'll basically come out to the same cost, the same risk, the same reward, the same probability, the same break evens, and so on. That's because either way, you're combining one bull spread plus one bear spread, which equals the butterfly combo. So whether you do a bull put plus a bear put or a bull call plus a bear call, either way, you end up in a butterfly and you have the same elements in place. So it really doesn't matter. We said the 115, 110, 105 put butterfly is what we're going to do, and we're going to look at that trading strategy next week. In conclusion, we are in this blow off top phase. Things can get really wild here. As we've been saying last week, coming into this week, I mean, you're starting to see it. You're already seeing it. ARM Holdings up 60%. These things are, Meta had the biggest one-day rally on its earnings, the biggest market cap gain in history. No company has ever gained more in market cap. Those things are what you see in blow-off top phases, and we might not be done. So expect some fireworks. We'll continue to keep you updated with market roundups throughout the week. Hope you enjoyed this trading room. Everyone have a great, safe, and happy weekend. On behalf of Maverick Trading, I'm Corey Halliday. We will see you next time.